Okay, before we head into the market outlook this week, just something I need to update you on my schedule coming up. In the bottom up series, FCX almost done. The video's already 4+ hours, but there's a lot to know to really get to know this company. I should be done this week. I just have the final few screens to get done, and that should be posted. Next, I'm moving on to, in the sector studies, utilities. August 27th, September 3rd, these are Sundays. You will get a market outlook as you normally do, followed up by the Q&A videos on Wednesday, September 10th, the Sunday, September 10th, and the Sunday, September 17th. I'm in Costa Rica and Panama. This is Costa Rica here, Panama there. So there will be no videos during those 2 weeks. And I'm not sure what kind of internet connection I will have available to me. I am staying at more higher end hotels there, so I should have fairly good internet connection. So I might try to do some smaller, shorter videos during that time. But I think it's safe it's a safer position to say if there's no expectation of any market outlook for those 2 weeks, that's probably the safer place to land. The 24th, this is the Sunday, the next Sunday after I am back. I am going to start instituting a new format for the market outlook. Rather than one video up on a Sunday that's an hour to an hour and a half long, I'm going to post more frequent videos and shorter. So when retail sales comes out, for example, I'll do a video on retail sales. And that allows me to go into more detail about that one report, but still keep the video to 7 to 10 minutes about that one report, as opposed to taking 7 to 10 minutes in the market outlook. So there'll be more frequent videos, and they will be shorter. Also, I'm back on September 19th. So sometime after September 19th, I'll be hosting, and I do this a couple times a year, I'll have some live Q&A sessions for CFA Level 1, Level 2, and Level 3, sort of 3 separate sessions, one for each level. And I usually do them week after week. So Level 1 first, next week Level 2, next week Level 3. I'll have more information on that. I'll post more on that as we get closer to that, but that will be sometime in September. And in September, late in September, I will have more information for you on the charter holder subscription that we're launching this fall. That being said, let's talk about what happened last week. Okay, let's look at the week that just happened. Don't think it's a shock. What the big story is the yield curve. And the long end of the curve has taken out, in quite a few of the tenors, has taken out the October highs. We're now printing new cycle highs on the long end of the curve. But two other important numbers came out this week, which I didn't hear much discussion about, if any discussion about. One is GDPNow. I was doing some work, and my iPad makes a noise whenever I get a notice. It makes a little ting sound. And I have the app for GDPNow installed, and I looked at the number, and I thought, oh, come on, that's a misprint. You meant to print a 2 or a 3, not a 5. 5.8. If you look at the summary of economic projections, the long-term real GDP trend growth rate, 1.8%. This is triple the trend growth rate. Triple. When we're going to read the minutes in a little bit here, and we're going to see that the staff forecast the recession is gone, but a period of below trend GDP growth will ensue. This is triple trend for Q3. Triple the trend, not below trend, not double the trend, triple the trend. I thought it's got to be wrong. It's got to be a misprint. So I went to the site to look at the components of the change. What happened today specifically? And every day there's an economic report. They have the subcomponent chart, which will give you a breakdown of all the components of GDP. The C, the I, the G, the X, the M. It'll give you all the breakdowns of where they feel that report suddenly resulted in a change in something. And 2 days in a row, you would think that GDPNow was a meme stock, the way it was shooting straight up the side of the chart. Let's start with retail sales here, 0.7% for July. Look at this chart here quickly at a glance here. What really stands out is the direction of autos. This is the big gray bar here. May to June, big step down. June to July, another big step down. Well, if you tell me where interest rates are, that there was another interest rate increase at the last meeting, that we're at 20-year highs, if not more, on the Fed funds rate, I would say, well, yeah, that seems to be consistent. That the interest rate increases, we can see, are having an effect there. Are they having an effect on other interest rate sensitive sectors like housing and durable goods? For housing, you would say it didn't seem to be so. The housing index, the National Association of Home Builders index, went from a low of 42 to 56, almost in a linear fashion, month over month, just kept going up and up. Housing stocks hitting 52-week highs, week after week after week, just on fire. Well, sound the brakes screeching to a halt. Mortgage rates between 7 and 8%. We saw the index make almost a 180. It was a big drop in that index. And let's have a look at some of the categories. Let's just skip table 1 for now. Let's just go to table 2 and just look at June over here. Motor vehicle and parts dealers, negative. Yeah, that's not surprising. Furniture, home furnishing stores, negative 1.8. Big ticket items, typically used with some kind of consumer finance, not surprising. Electronics and appliance stores, again, appliances, big durable goods, typically bought with some sort of consumer financing, negative 1.3. The interest rate sensitive sectors are doing what we think they should be doing. Let's go back up to table 1. Some confusion of how to read table 1. We always read the seasonally adjusted for July. For whatever month you're in, always look at the seasonally adjusted. If you're looking year over year, July of this year over July of last year, you don't have to look at the seasonally adjusted. You can look at the not adjusted data because you're comparing a July with a July. You can compare a December with a December. You can compare an August with an August, but you cannot compare a December with a May, or a December with a February, or a December with a January, because they have different seasonal components to it. You can't compare a Christmas month with a non-Christmas month like a January, in which there are also no other offsetting holidays like Valentine's Day, Mother's Day, things like that. August is back to school. So if we saw on the unadjusted numbers, August come in 2% higher than July, would you say, the consumer is on fire? What if the normal increase is 3%? Well, the consumer's not on fire. The consumer's really holding back. You gotta spend money on back to school, but they're really holding back. That's why it's important to look at the seasonally adjusted numbers. And you have the raw numbers. When I say the raw numbers, the aggregate dollar numbers here, which I don't think are that useful overall, because out comes the calculator and you'll end up producing table 2. So let's just look at table 2. And here, this is over June of 23. This is over July of 22. And we are seeing the big negative numbers where we would naturally expect to see the big negative numbers. Gasoline stations over the year down almost 21%, but up 0.4 month over month. Let's look at this next table. What do we get here? Here is the standard error, previous month to the current month, 0.3. This can be important depending on the numbers that we have up here, and if you're questioning the size of the sample. What is the difference? For you level 1 candidates out there, what is the difference? We're going to do a quant question now. What is the difference between the standard error and the standard deviation? The standard error is a measure of precision. It measures the precision of your estimate. Our estimate being, for retail food and services, the total 0.7. How precise is that? A standard deviation is a measure of dispersion in the population. So if we took a number of samples from the population and we looked at the standard deviation of each sample, we would expect those standard deviations to be within a tight range. That each sample we take, we're not going to get the same standard deviation, but in and around the same number. It'll be fairly stable. If we then changed our sample from 5,000 observations to 8,000 observations, we would still expect to see the standard deviation be fairly stable, but the standard error would shrink. The larger the sample size, the smaller the standard error, because we're getting more and more precise. If you could sample the entire population, you would have the number that you want. But we have this 0.7, and we may say to ourselves, how confident can we be that that number is a real number, that that number is actually positive, given the sample size that we have? I mean, we're not sampling the whole population. Could it be that it's just so imprecise we can't rely on it? That's what the standard error is for, 0.3. So we can construct a confidence interval around it. It's a large sample. We would use a Z statistic, a 95% confidence interval, plus or minus 1.96. So let's just double this, multiply by 2 instead of 1.96. You get 0.6. So our interval around the 0.7 is 0.1 to 0.13. Does not contain 0. So we can be 95% confident that July's retail sales came in on a seasonally adjusted basis above June. We can be 95% confident of that. And then, of course, you have all of the categories here, and you have all of the standard errors. So you could take these standard errors, look at motor vehicles and parts as 1, multiplied by 2, you get 2. Let's have a look at motor vehicles over here. We have negative 0.3. So the interval that we construct would contain 0. Right almost in the middle, would contain 0. We cannot be with 95% confidence interval, we can't be sure that this number is any different than 0. So maybe, based on the sample size we have, we just don't have enough information to know whether this is significantly different than 0. You can go to a lower confidence interval. They do use 90% confidence intervals in this report, and they give you the Z statistic that they're using, plus or minus 1.753, to create a 90% confidence interval. This is here, the confidence interval. You can see that they give you they give you the statistic to use to create a 90% confidence interval. Even at 90%, that number is no different than 0. So you might want to go into that kind of detail and say, well, let's see how many of these categories are significantly different than 0. The ones that are significantly different, I have confidence that there's something going on there, but this is sampling. This is a sample of the population, and there's going to be some error in our estimate called the standard error. With that, we can construct intervals to see how many of these are significantly different than 0. Again, if you're interested in that kind of stuff, look at that. Level 1 going to work for you already, right? Let's look at the shocker. GDPNow. This is changes in the subcomponent. So when you get to GDPNow, you're on this this site. This is your landing page. You'll get this. Most people just stop at this point, but the interesting stuff is down here. Subcomponent contribution charts. Click on that. Select a quarter. Here's the third quarter. Go down to this one, and this is every day an economic report comes out, the model changes. Because at the beginning of the quarter, they have all of the estimates in. And this is our best guess based on the median of all the estimates. This is our best guess what GDP will be. Then a report comes in. If the report comes in exactly as estimated, GDPNow doesn't change. If it comes in higher than forecasted, it will change. If it comes in lower than forecasted, it will change to the negative side. So it'll either go up or it'll go down. So if you have a lot of positive macroeconomic surprises, and a surprise means that the actual number comes in higher than the estimated number, you will have GDPNow going up. Well, look what happened here. Let's go to this day. This was on the 15th. Retail sales were released on the 15th. GDPNow forecast 5%. The previous forecast 4.1, and it tells you the very next line, the total change in GDP 0.94. Then it gives you the components of GDP, C plus I, And here we have G and X minus M. So I'll try to put my mouse inside this box without it changing. Consumer, there's the C, 0.82. Well, retail sales really is about the consumer, so retail sales came in better than expected, so up goes the estimate for the C component of GDP, 0.82. Next we go to I. You can see three components of I there: non-residential fixed investment, residential fixed investment, and change in private inventories. Then you have a G component. We see at the very bottom G is 0. Then you have your X minus M, and here net exports is the X minus M component. So you have all your components of GDP, and this model is based on macroeconomic surprises, the estimate versus the actual. So we went from 4.1 to 5 because retail sales came in stronger than expected. Let's look at the next day. This is the one that got me when I saw it. GDPNow forecast 5.8. That's real GDP, not nominal. That is real GDP. I want you to let that sink in a little bit. Real GDP, 5.8%. These are China growth numbers for the US, right? 5.8%. China doesn't even have this growth rate. 5.8%. The total change here today on the 16th, after being changed on the 15th, on the 16th another change, another 0.72. The consumer up another 0.3. And we had housing starts and industrial production. So we really should see the component of residential investment increase. And if you look down, residential investment up 0.44, non-residential up 0.03. Inventories, I guess that came from industrial production, and no change in net exports or government spending on this one. So residential investment up 0.44 because housing starts were strong. But let's be careful here. When we look at the index, it showed a very sharp turnaround. Well, that's not in this because it's not output. It's not measuring output. It's just a survey that goes out to home builders saying, what are you seeing here? What are you seeing there? And it creates a diffusion index. But this just shocked me to no end. 5.8%. This is probably not what the Fed wants to see, and it's probably not going to be good for inflationary pressure because this is triple the trend growth, a little more than triple the trend growth. At least if I'm remembering it correctly, the long-term real GDP in the summary of economic projections was printed at 1.8. Colossal. Against a backdrop of, let's look at the U.S. leading indicators, negative again for July. Can we remember when it was ever positive? Negative again for July. And here are the components. You have financial components, non-financial components. The financial components, is that a shock? The S&P 500 just seems to be the one that says, nope, 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 we're not paying attention to what you have to say. We're not listening to you. We don't care about high rates. Higher, we're going to the moon, diamond hands. 0.54. Not so much in the last couple of weeks. And that's my fault. I was short the index for that whole rally. I gave up. I said, that's it. That's it. I'm not going to keep fighting this fight. And since I've given up, the index is down 230 points. That, again, is my fault. If I had not covered my short position, we would be printing new all-time highs on the index. I have that power. I don't know how to use it for my own benefit. It just seems that I can only benefit others, but I have that power. Non-financial components, building permits, private housing, 0.19, and that was really the case for the first half of the year. I mean, we could see it, but that is turning around. You get mortgage rates up to 7 or 8%. That has to deter, at the margin, that has to deter people. You can see there's no little blue tick here showing this is the blue over here is the, where does it say? There it is July for 23. Nothing there. And then manufacturers, new orders, consumer goods and materials. These are the only three things that are showing being above zero. We also got import and export prices. This is the trend. This is a 12-month trend line. This is the 12-month percentage change, so it's just year July 22 over July 21, and you can see that it started going negative at the beginning of the year, and it's been negative all the way through, and now we just have a little turn up over here. So we have to try to figure out, well, where's that coming from? Let's go to our table here, imports and exports. Is the U.S. importing inflation 2023 July 0.4%, higher than you'd like to see, 0.4%. However, fuel 3.6, non-fuel 0. Okay, so no increase month over month on all the other stuff. Fuel up 3.6, but I think we knew that there'd be some pricing pressure on that. Let's look at the exports, 0.7, up 0.7%. Agricultural exports up 0.9, everything else up 0.6. But that is stuff that we're exporting. That's some other country's problem. They're importing that price index. They're importing 0.6% month over month. The U.S. is exporting that. So that's not so bad. That's actually kind of good. They're not importing inflation, which is a good thing. Fed minutes. You should be reading these. It's not long, 10 pages. Take off the first and last page because there's really not much there. You really got about 8 pages. It's interesting. You read it because you want to know, well, what kind of stuff do you guys talk about and what kind of stuff do you look at, right? Let's start with the staff review before we get to the committee members. We'll start with the financial situation, just one paragraph here. Over the intermeeting period, market participants, that's you and me, market participants interpreted domestic economic data releases as indicating continued resilience of economic activity and some easing of inflationary pressure. And they viewed monetary policy communications, this is what the FOMC members say, their speeches, the minutes, the press conference. They viewed monetary policy communications as pointing to somewhat more restrictive policy than expected. Do you mean they finally are listening to the Fed when the Fed says higher for longer? All that, we don't believe you, we don't believe you. Do you mean to tell me that now they're saying, I guess we'll believe you? Pointing to somewhat more restrictive policy than expected. Well, the communication was quite clear the whole time. And then this line here I just find very comical is that as everyone's waking up going, oh my God, they were serious all along. We didn't expect that. Well, there we go. That's kind of an interesting paragraph. Let's go down to the economic situation. Oh, we got a little bit more here. Conditions in domestic short-term funding markets remain generally stable. Following the suspension of the debt limit, the Treasury Department partly replenished the TGA, the general account, via a large net increase in bill issuance. Auctions of Treasury bills were met with robust demand. Shorter-term bill yields increased relative to other money market rates. And the reverse repo take-up declined notably, about $390 billion over the intermeeting period, reflecting more attractive rates on some alternatives to investing in the reverse repo facility. Issuance of leveraged loans remained limited, reflecting low levels of leveraged buyout and merger and acquisition activity, as well as weak investor demand. And there is some chatter in this space that even if you ask for a loan, even if you funds that say we do this and you even ask for a loan, the rates are ridiculous and there's not that much eagerness to give it to you to begin with. Let's go down here. Staff economic outlook. Big change here. The economic forecast prepared by the staff for the July FOMC meeting was stronger than the June projection. Since the emergence of stress in the banking sector in mid-March, indicators of spending and real activity had come in stronger than anticipated. As a result, the staff no longer judged that the economy would enter a mild recession towards the end of the year. However, the staff continued to expect that real GDP growth in 2024 and 2025 would run below their estimate of potential output growth, leading to a small increase in the unemployment rate relative to its current level. Well, It does not, I mean, we're only in Q3 of 2023. They're talking about 24 and 25, but it does not seem to be drifting in that direction. So unless they expect that by the time you get to 2024, it's all going to be over, well, it's not headed there. The staff continued to project that total and core PCE price inflation would move lower in coming years. Much of the step down in core inflation was expected to occur over the second half of 2023. Much of the step down in core, the second half of 2023, so they are expecting it to come down. That might influence the Fed in terms of saying, well, why don't we just hold off on our rate increases here? In assessing, here is the participants now. We're done with the staff. This is the participants. In assessing the economic outlook, participants noted that real GDP growth had continued to exhibit resilience in the first half of the year, and the economy had been showing considerable momentum. A gradual slowdown in economic activity nevertheless appeared to be in progress. Think again. To be in progress, consistent with the restraint placed on demand by the cumulative tightening of monetary policy since early last year. That 5.8 is not even consistent with the idea that a slowdown in economic activity is in progress. Participants commented that monetary policy tightening appeared to be working broadly as intended, and that a continued gradual slowing in real GDP growth would help reduce demand-supply imbalances. Participants noted the recent reduction in total and core inflation rates. However, they stressed that inflation remained unacceptably high. Let me just stop there for a minute. When I'm comparing what the Fed is saying about real GDP with what the Atlanta Fed GDPNow is saying, they are saying two very different things. One is saying we're seeing movement in real GDP going down. The Atlanta Fed is saying, well, that's not what we're seeing. It's climbing the right side of the chart straight up like a meme stock. GDPNow is still just a model. It's not reality. It is still just a model. And anybody's forecast is not reality either. It is just a model. It's just that what GDPNow is saying is not just slightly different or a little different or different. It's diametrically opposed to what is being said by the participants in the meeting here. Let me just read the sentence I read a second ago here again. Participants noted the reduction in total and core inflation rates. So it's not a matter of this is the biggest enemy in the room right now, is that they are now acknowledging that it is losing strength. However, they stressed that inflation remained unacceptably high and that further evidence would be required for them to be confident that inflation was clearly on a path towards the committee's 2% objective. Participants continued to view a period of below-trend growth in real GDP and some softening in labor market conditions as needed to bring aggregate supply and aggregate demand into better balance and reduce inflationary pressure. Participants noted that consumer spending had recently exhibited considerable resilience, cited other factors that were likely to or appeared consistent with a slowdown in consumption, including the declining stock of excess savings, softening labor market conditions, and increased price sensitivity on the part of customers. And I'll use this argument later on, the declining stock of excess savings, as potentially a solution to the puzzle I introduced earlier. Recent increases in home prices suggest that the housing sector's response to monetary policy restraint may have peaked. They might have said that too early. Moving to the business sector. These included better functioning supply chains, lower input costs, and an increased ability to hire and retain workers. When I say these included, it's they say various improvements. These included. I'm not highlighting everything. Factors that could lead to lower economic activity. Continuing economic uncertainty, the vulnerabilities of the CRE market, and ongoing weakness of manufacturing output. They noted evidence that labor demand was easing, including declines in job openings, lower quit rates, more part-time work, slower growth in hours worked, higher unemployment insurance claims, and more moderate rates of nominal wage growth. That's quite the laundry list, but all of those things are true. They are all pointing to an easing in the labor market. Participants judged that further progress towards a balancing of demand and supply in the labor market was needed, and they expected that additional softening in labor market conditions would take place over time. Cited a number of tentative signs that inflation pressure could be abating. This is new language. In previous minutes, they really didn't want to give any space to that argument. These signs include some softening in core goods prices, lower online prices, evidence that firms were raising prices by smaller amounts than previously, slower increases in shelter prices, and recent declines in survey estimates of shorter-term inflation expectations of inflation uncertainty. Nonetheless, there's an old saying that everything is meaningless before the but. Nonetheless, several participants commented that significant disinflationary pressures had yet to become apparent in the prices of core services excluding housing. Participants stressed that the committee would need to see more data on inflation and further signs that aggregate demand and aggregate supply were moving in a better balance to be confident that inflation pressures were abating. So what I take away from this is that they've said in two places, higher interest rates appear to be having their effect. Number two, we are seeing inflation coming down, and here's a whole bunch of things we see inflation coming down on. I should say we see three things. Number three, we see some softening in the labor market, and here are all the things that are pointing to the softening in the labor market. And we need softening in the labor market to get to where we want to go. And so they're all moving in that direction, and they're saying we need to see more data. Well, okay, so you need to see more data, but I don't know that what you're sitting on right now says we should go another 25. I think based on that, if I had to stop there, I'd say, well, it seems to me that you feel fairly confident at these levels. I don't see any rate cut in what you're saying, but I don't see a rate hike in what you're saying. I see patience now in what you're saying, that you're going to wait and see what happens. I think they're more willing to do that. But we find out, we'll get a little bit more insight this week. Jackson Hole this week, Wednesday, Thursday, Friday with Powell's time in the spotlight on Friday morning at 10:05. In discussing downside risks to economic activity and inflation, and there is new language coming up here. All the previous meetings was, we're not concerned about the economy, we're concerned about inflation, The other part of the mandate we don't care about right now. Well, the other part is starting to show up. In discussing downside risks to economic activity and inflation, participants considered the possibility that the cumulative tightening of monetary policy could lead to a sharper slowdown in the economy than expected, as well as the possibility that the effects of the tightening of bank credit conditions could prove more substantial than anticipated. This is the first time in the minutes for quite some time that they're giving a nod to the second part of their mandate. Slight nod, but it's still a nod. Participants also commented on risks associated with a potential sharp decline in CRE valuations. Potential sharp decline, that's already going on in some sectors, and not just sharp, we're talking in some cases 50% of the value of the building that was purchased 4 years ago was gone. Sharp declines in CRE valuations that could adversely affect some banks and other financial institutions, such as insurance companies that are heavily exposed to CRE. Amid these economic conditions, almost all participants judged it appropriate to raise the target rate for the federal funds rate to 5.25% or 5.5% at this meeting. So they're seeing all of these things, and then they're saying, well, let's raise rates. Now, they were already seeing progress in inflation, already seeing progress in the labor market. Inflation still stubbornly high or unacceptably high, and now worried about risks to the downside in the economy, mentioning it, and they thought it appropriate to go. I do believe that was their last bullet. Unless inflation reaccelerates, even if it just stays sideways and starts dropping, not as fast as they want, but starts dropping, I think they're just going to let it go and hold rates where they are. And let the market do the tightening, because in the last couple of weeks, the market has done a lot of tightening by raising that long end of the curve. Participants noted that this action will put the stance of monetary policy further into restrictive territory, consistent with reducing demand-supply imbalances in the economy and helping to restore price stability. A couple of participants indicated that they favored leaving the target range for the federal funds rate unchanged, or that they could have supported such a proposal. They judged that maintaining the current degree of restrictiveness at this time would likely result in further progress towards the committee's goals, while allowing the committee time to further evaluate this progress. All participants agreed that it was appropriate to continue the process of reducing the Federal Reserve securities holdings as described previously. Look at blue. A number of participants noted that balance sheet runoff need not end when the committee eventually begins to reduce the target range for the federal funds rate. New language. Never gave a nod to when they were going to reduce rates. It was always higher for longer, and we're not even discussing it. Now they are discussing something about it. That, hey, even when we do start cutting, so that is in their future, they do see that in their future, even when we do start reducing the target range, we should let balance sheet continue to run off. That is new language as well. Most participants continue to see significant upside risk to inflation, which could require further tightening of monetary policy. That seemed to be the line that got all the attention, but it's the same line that's been in all the minutes. It's the same line that's been there. So I don't know if it's just you take the last minutes and you add the newer stuff and you leave a lot of the skeleton of the minutes there, or if the minutes are written from a blank sheet of paper every time and this sentence is specifically added. This is new. A number of participants judged that with the stance of monetary policy in restricted territory, risks to the achievement of the committee's goals had become more two-sided, and it was important that the committee's decision balance the risk of an inadvertent over-tightening of policy against the cost of an insufficient tightening. It was never balanced before. Now they see it as balanced, as two-sided. It has become more two-sided. Their other mandate is starting to show up. This is a reading of these minutes leads me to believe that 25 basis point increase was for good measure. Let's do another 25. We're here. Another 25 for good measure. And being that we're here, our two mandates seem to be more in balance right now. We got to be careful. We don't want to have to run and fix the other one. We got to be careful. This sounds to me like a Fed that has reached the end of this phase, the hiking phase. Phase 2 is the hold. Let's see how long that lasts. All right, yields. WOW. That spells wow. Not week over week, but wow. Money market rates all well behaved. They are where they are. And I think that is pretty much what you're going to see week after week, is they're all being very well behaved. But you do have rising rates in the long end of the market, and here you are getting a curve steepener. If you look at the change in slope, all of them increased week over week. And on the 7-year, the 10-year, and the 30-year, August 18th printed new cycle highs. We've taken out the October highs on those yields. The 20-year just sitting a little below, taking out the October lows, and at 4.38, I think it was got up to 4.41. Still, the 5-year is still hanging in there. The 2-year 4.92 versus 5.05. That'll be interesting to see where that goes, because the 2-year does import within it a significant expectation of future monetary policy. We usually say that capital market rates reflect, the real GDP and expected inflation, and money market rates will reflect monetary policy. The 2-year kind of has a foot in both worlds. It will import within it some expectation of where Fed funds futures are going, and it is sitting below the 5.05. We see it breach 5.05, which, depending on what they say in Jackson Hole, what Powell says in Jackson Hole this week, just might. Who knows? But those yields are going up on the long end of the curve. To me, this looks like a good buying opportunity for bonds, because even on the let's see, the 10-year, 4.26%. If you believe that there is going to be a rate cutting cycle coming up, or you believe that globally these high yields are going to break something, as they have consistently always done. If you believe that they're going to break something, then this is where you want to be. You want to be in something that has duration. At least I want to be in something that has duration. So I am favoring the long end of the curve. I'm buying the 2048 still. The 2048 bonds. And if you are looking for duration, if you want a real nice kicker out of duration, find a long-term bond that has duration. Get a low coupon. You will get a higher duration, and it'll be more tax efficient. Negative 129 basis points on the 3-month to the 10-year, negative 189 on May 3rd, so it's 60 basis points steeper at this point. SOMA ran off 42.7 billion down to 7.417 trillion. Fed balance sheet also ran off even more, down 62 billion. The SOMA's down 42, so there was a net almost 20 billion runoff. Money market funds continue to suck money in. Increased by another 40 billion, 5.57 trillion for the week. Retail up 15.6 billion, institutional up 24.09 billion. Government still raking it in. Why not? Look at these rates, and they're stable. Week over week, we're seeing very little movement in these rates. They're stable. So money market funds can start thinking about, well, the 6-month now. I'm not importing any duration risk in there. It's fairly stable at this point, all the way to the 1 year, fairly stable. Even going into the 2-year at 3 basis points week over week is fairly stable. 11 billion and 26 billion prime, almost 7 billion for retail. Drop here on institutional. September 20th, next FOMC meeting, 31 days away, and the belief is still zero. I'm there as well. I don't disagree with this distribution. Jackson Hole Symposium this week, Wednesday to Friday, and Powell, 10:05 a.m. on Friday. And I'm certain he's going to have something to say about the rise in yields, because the market right now is tightening monetary policy at the long end of the curve. Mortgage rates are being pushed up. Tuesday you have Barkin, Bowman, and Goolsbee. December, what we had last week, a shifting down to 5.75 on the probabilities for December. Now you have it flipped back the other way. You basically just had these two things swap positions. Back down to 60% on 5.5, meaning no further increase. That should have eased some pressure in the bond market, but it didn't. It seems to have its own momentum right now. Effective federal funds rate 5.33. Reverse repo moving around here, up 46 billion. Week to week, I think you'll get these movements around. I don't know where this, if it continues to increase, then it's, another big question mark there. Lags, 12-month lags, still the effect still to be felt, or if we believe that 300 basis points, the effective federal funds rate 12 months ago was 2.33, so we'd expect that is fully in now, and on average, weighted average, 300 basis points to be felt. Real yields, all of them, the 5, 7, 10, 20, 30, all of them last week, new cycle highs. And it was Williams, I think, that brought up this point that said you have to keep your eye on the real yield as where we are in restrictive territory, because even if you hold the Fed funds rate constant, that's a nominal yield, as expected inflation begins to drop, real yields will rise, which is making monetary policy more restrictive, even if the Fed does not raise rates. That his argument is they may have to lower rates just to counter the rise in the real rate as inflation expectations drop. and you had real rates print cycle highs this last week, still with an inversion from the 5 to the 10. Inflation expectations dropping. Fed funds futures all seem to be pointing to the market slowly accepting week after week after week the higher for longer. If you look at end of Q1 2024, the end of March, 5.29 implied on the index versus 5.27, so it's up 1.5 basis points to 5.29. And by the end of the second quarter, by the end of June, the market is putting it into the 5.5 to almost 5% from 4.95. And overall of 2024, it is just 116 basis points lower. 1 month SOFR at 4.26 versus 5.4 for this December. It was as much as over 150 at one point, implying 6 rate cuts. Well, this is now down to 4.5 rate cuts. That probably, if nothing breaks week after week after week, if the economy keeps doing what it's doing and nothing breaks, then this will slowly work its way to zero. TLT didn't have a good week. Again, what's shocking there? My fault, because I am big on TLT now. All my options expired on Friday. Anything that was, most of it was put to me during the course of the week. There were a few stragglers that made it to Friday that were assigned to me. Everything is assigned to me now. I've got a little over 30,000 shares now, 32,000 and change. Down 1.68%. SPY down 2.05%. Yields increasing. TLT down means money is flowing out of this. SPY down, money is flowing out of the market. Or I shouldn't say money is flowing out of the market, but value is leaving TLT. Value is leaving SPY. I don't say, it's hard to say money is flowing out because somebody's selling something at $80, somebody else had to buy something at $80. So, we'd say value is leaving. Implied volatility, 13-week, 89%. It did look on Friday that TLT was going to have a good morning. Early in the morning, it was up almost $1, and it looked like it was poised to recover much of what I think is an oversold security, the long bond. But then nope, we don't want to have anything to do with that. Well, maybe we do. No, maybe we don't. It was an odd Friday. It did eke out a small gain for Friday, which I don't know if it's enough to say that okay, we've put in a bottom on TLT. On this one here, I don't know, because I think it is right now more sentiment driven than fundamentally driven. So let me explain that. Let's say that you take some money out of the bonds. You sell the 30-year U.S. Treasury. Where are you going to go? You have to go somewhere. Money has to go somewhere. The most obvious thing is, well, it's going to go to the front end of the curve. It's going to go into money market securities, and we are seeing week after week that is going up. But are you going to another country? Are you going to another country's bonds? Where are you going to go? Now imagine something falls apart. Fear in the global economy increases significantly. Where are you going to go? Tell me where you're going to go. What other market has the depth and the size and the safety that you need to put your money somewhere? Because money never just sits in cash. You never just take it out of the bank and put it in a bag and stick it in a drawer at home. Money sits somewhere. It has to sit in something. Where's it going to go? It's going to go right back into U.S. Treasuries. Right back into U.S. Treasuries. So all of this negativity about that bond market is way overblown. Yes, there are fiscal problems in the U.S., but there are fiscal problems in Japan, there are fiscal problems in Europe, there are fiscal problems in Canada. You need a market that's big. Find me a big market. And when you get to that big market, find me the safest of those big markets. By far, it's the US. By far, it's the US. So in times of stress, one thing that we should see is a rising US dollar, because that's where money runs to hide. And we are seeing a rising US dollar. Yet we're seeing a market going down. We're seeing a bond market go down. The question is, and the puzzle that I'll show you shortly is, where's all that money going to? All right, if we look at Freddie, the 30-year FRM 7.09, that's of the 17th, from Mortgage News Daily, updated on the 18th, 7.37. And if you look online at mortgage rates in different, just Google it, you'll get low 7s to mid 7s to upper 7s. It's ranging between 7 to 8%. U.S. Treasury Thursday over Thursday increased by 21. We can see here you had a 13 basis point increase here, so the spread decreased by 8 if we're using Freddie's mortgage market survey number. That did not help the home builders. Neither did this over here. This is the National Association of Home Builders Housing Index 50 from 56. Went from 56 down to 50. That is a big drop in 1 month. That is a huge drop in 1 month. And mortgage rates breaching 7% over here. Look at all the home builders really giving back. Still at decent prices, still at elevated prices, but giving back. DHI, I think, is sitting around 113. I don't know that I would be interested in building back a significant position there until I saw it under 100. So maybe this continues for a while. Mortgage REITs not doing well there either. Mortgage apps down 8.8%. Building permits up 0.1. This is what GDPNow was focusing on. Housing starts. This was for July, 3.9. But keep in mind, this housing index is August. So this is, if we think about a timeline, housing starts were here. This is over here. So GDPNow was, changed for the number for housing starts, but it does not change for this because there is no measure of output here. It's just a matter of, hey, home builders, what do you think about this? What do you think about that? Going from 56 down to 50 is a major, significant turnaround. Corporate spreads, OAS, just don't care what's going on. Look at those small moves. They just don't care. It's like they're in a world of their own. Okay, let's look at some currencies. I had converted all my Canadian dollars to US dollars, and it has worked out quite well, thank you. I did this at around 131.90, 131.95. Which is somewhere right around here, all right, in this area here, and it's worked out quite well, so thank you very much. And it was a significant amount I had exchanged, so this did a lot to offset the black eyes that I got from beta, from being short beta, so thank you for that. Here's the dollar index, up 3.48% over the same period of time. Here is the euro, down almost 3% over that period of time. So the Canadian is weaker, the euro is weaker, the dollar index is stronger over that period of time, 3.48. Here's my puzzle. For this to happen, money's got to be flowing into the US dollar against these other currencies. That's how the price changes, is there's more money flowing into one currency and money flowing out of another currency, buying of one, selling of the other. That's how it happens. So I think it's enough to say that money is being attracted to the US dollar. But SPY is down 4.11. The 10-year yield has gone from 3.8 to 4.26. The 30-year has gone from 3.91 to 4.38. Price is down over here. Price is down over here. Over here, price is down. Money market rates, 5.49 to 5.55 over that period of time, fairly stable. It's not as if money market rates are really dropping because everyone's trying to squeeze in. Money market rates are fairly stable. If a lot of money needed to hide in these short-term T-bills, it would push the price up, it would push the yield down, would see the yield drift more closer towards the 5.25. So it's not going into the money market to the extent that we would expect. It's not going in the 10-year, it's not going in the 30-year, it's not going in the SPY, it's not going in the small caps, it's not going in the NASDAQ, but it's going into the US dollar. So it's going into the US dollar. It's got to sit somewhere, but it doesn't appear to be going into equities because it would be supporting or pushing up the price. It doesn't appear to be going into the 10-year. It doesn't appear to be going into the 30-year. It doesn't appear to be going into money market funds. Where the hell is the money going? It's a puzzle. I look at that and I go, but it doesn't add up. The components don't add up. The money should be going somewhere. To move the dollar index by 3.5 percentage points in a month, and over that same month have the major equity index drop 4%, have the 10-year yield increase 46 basis points, have the 30-year yield increase 47 basis points, and money market rates show no pricing pressure there at all. Where's it going? If you have any ideas of where the money could be going, let me know. It's got to sit somewhere. Where the hell is it sitting? Canada and Japan was the same way with their inflation. Showed an uptick in inflation. The last inflation reading we got from Canada was very positive. Well, not now. Core inflation forecast. See, look at the previous. Negative 0.1 all the way to 0.5 on the core inflation. So this is stripping out food and energy, which are volatile. The core inflation from negative 0.1 up to 0.5. This is the month over month for July. The forecast was for 0.4, so it came in higher than expected. Year over year forecast for 2.8 came in at 3.2. The inflation rate headline a year over year forecast was 3, came in 3.3. And the inflation rate, the headline month over month, was forecast 0.3, came in 0.6. None of that is good. However, there is a very strong belief that the Bank of Canada is just not going to do anything about it because the Canadian consumer is far more interest rate sensitive than the U.S. consumer, primarily because of two things: the nature of our mortgage market and just the sheer level of household debt as a percentage of disposable income, much higher in Canada than the US. So the average Canadian has far more debt than the average American, and that debt is far more interest rate sensitive than the average American. Take those two things, you push a little bit more, you don't just break a few things, you'll break a lot of things. But this is interesting. So let's go back to the puzzle. Here's the best answer I have for the puzzle, or the best possible answer I have for the puzzle, is that yes, money is flowing into the US for the safety, and it is flowing into the bond market. It's that the domestic holders are pulling money out faster than foreign holders are pushing money in. That could be it. It could be, yes, you have a net inflow coming into the US dollar, and that is going to buy some financial assets. Typically, when it's looking for safety, it's going to buy in the Treasury market. So maybe it is buying in the Treasury market, but domestic holders are selling in the Treasury market because they've spent down their pandemic savings, and now they have to figure out how they're going to pay for everything that they paid for, or that they loaded up on, because we did see consumer credit breach $1 trillion now. Could it be that all that pandemic savings is gone, and to keep your spending going, to keep consumer spending going, you got to start dipping into your savings, and you're selling your securities to come up with money to spend? Could it be that the domestic holders are just selling their securities so that they can continue spending or coping or meeting their day-to-day needs while you still have an inflow in? Could all those things be true? Now, if you say, well, the domestic holders, if they're selling, that would not that would not affect the US dollar because nothing is being exchanged. There is no currency conversion that has to happen there. It's got to be something in the domestic market that is overweighing the money that's going into the US dollar, because again, that money has to go somewhere, and usually when money goes into another currency, at least at this rate, over a month, it's usually because of some kind of stress and it wants some place to hide. It usually hides in treasuries. So if that is what's going on, then money is looking to the treasury market to hide, and the U.S. consumer is at the end of their pandemic's savings and are now dipping into their stock of savings in terms of the financial assets they have to continue on. Another explanation could be, well, the retirees in the U.S. generally are mostly in fixed income by the time they retire, and they have to harvest so much of that every month because that's their income. Maybe that's what's going on. Either way, I find it a puzzle that you have money flowing in to the US dollar, but not going into the market, not going into the 10-year, not going into the 30-year, doesn't appear to be hitting the money market. Where the hell is it going? Okay, let's review the earnings season. Big week for earnings this week. You may say, wait, I thought we were already done. And it says here, during the week of August 21st, only 12 companies are reporting. But one particular company is reporting that started this whole rally, that just started the whole ridiculousness of it. And it is reporting again, and that's NVIDIA. If you'll recall, the last time NVIDIA reported, the whole AI hype just went in overdrive. And it was AI, everybody talking about AI. And last week I put some charts up showing the number of mentions of AI on conference calls, like just right off the charts. The record number of mentions, record number of companies mentioning AI, everyone getting in on the act. And it all started with NVIDIA, and NVIDIA reports Wednesday. NVIDIA has the power, I think, to continue this rally, to reignite the AI fury and keep it going, or to kill it if they miss. If they come out and they say, well, okay, it's not 50% growth, we're going to get maybe 13% growth or 15%. If they miss, if they don't keep it going, then that could be as quickly as they started it, they could end it. So when I say big week in earnings this week, it is a big number. I think everyone's going to be heavily focused on NVIDIA to see, is that story still alive? And if it is, it could cause another silly rally like the last one we had. What do we got? Look at this. As earnings were coming out, much better than expected. The tune of 7.8%. And the surprise factor, 7.8%. Above expectations. Revenues 1.7% above expectations. The forward 4 quarters down here 231.73, given the closing price on the S&P, and this is Thursday's closing price. You'd have to look at Friday's closing price, which would have resulted in a better number here, 18.9. So the forward PE below 19 and below 18.9. Really on a forward basis. That is down from 20 to almost 21 that we saw, down to 18.9, coming into more reasonable territory. Combination of two things. This number has been increasing. The forward 4-quarter EPS has been increasing, and the market price has been decreasing. Let's look at the earnings this week. What do we got? Who cares? Bath and Body Works. Who cares? You have Advanced Auto Parts. Sorry, that's not earnings this week. That is a positive predicted surprise and negative predicted surprise. Earnings here. Nordson. I'll get it. Lowe's, the big one here on Tuesday. Wednesday, there you go. Nothing else matters. I don't think this week nothing else matters. It is It is the earnings report that everyone's waiting for. Does it keep it going, or is it over? This is it. It's in the grand scheme of things, it's not the most significant company's earnings that you want to hear about, and it's not the most significant thing you want to pay attention to, but for the story that caused the rally, a big part of the rally, for the story that really caused it, this is it, right? So Wednesday, and this is 4 p.m. after the close. You're going to have to wait all the way to after the close on Wednesday. Then you have Dollar Tree the next day, and then that's it. Nothing on Friday, but Friday at 10:05, you have Powell from Jackson Hole. And also on Friday, in case you're thinking of nibbling on GM and Ford, be very, very careful. Friday is the union vote. And I have something to say about that. Well, you would have to be living in a prison cell, I think, if you haven't heard of this guy, Oliver Anthony, and his song, Rich Men North of Richmond. It has been up for 11 days, 27 million views, 113,000 comments. And I urge you to read the comments. It is almost incredible. There's nobody with a negative statement. It is just a brotherhood of workers in the comment section, all nationalities, all skin pigmentations, all genders. You want to find diversity where everyone's getting along and everyone agrees and everyone's on the same page. It's in this guy's comment section. The left would be jealous, and the left is eager to call this guy a white supremacist, and the left would be jealous at just the level of brotherhood and love in the comment section. And if you read the comment section, it's a song for labor. It's an anthem for labor. And it's full of emotion. You have to ignore the words. I've seen some articles attempt to intellectually deconstruct the words that he uses, saying this is not true, and this is not true, and this is his own fault. And it's like you're missing the point. This is a song about angst, about emotion. You can't intellectually deconstruct an emotional statement. And it resonates with workers. You have a union vote on Friday. To believe that the union membership hasn't heard this and circulated it and shared it and posted it, that's probably a given that everyone has seen it. And when you listen to it, even if you're not a worker, even if you're not in that angst, his voice and his emotion and his expression and his loneliness, one man on a stage with no one to help him, all alone. Just the visual of it is powerful. Number one selling song on iTunes. Number one. This has turned him overnight into a financial success, because what you have here is raw authenticity. He wasn't trying to say what he thought people wanted to hear. He said what he needed to say. And just read the comment section. It is powerful. Don't write this one off. This is going to be important. And when these workers go into that voting booth to vote on Friday for a strike, they're probably going to return the biggest mandate the union has ever had, because this song will be in their head when they're in there. That emotion will be in there with them. That's what's going to be voting this. I wouldn't be touching GM or Ford or Stellantis at all, because this is what you need. This type of raw emotion is what you need to move a group of people to sacrifice something for the fight, which means their income going into Christmas, that they will be far more willing to strike because of this. I think this. Now, they would have returned a mandate to strike, but it's the numbers that are important. 89% voted in favor is different than saying 100% voted in favor. If your management on the other side of that number, 100%, that's a movement. That's something you can't ignore. The union, I think, if they haven't circulated this song to all of their members, better do it, because it's in their best interest. This is a weapon for them. When I first heard it, I thought, well, he's a good singer. And I listened to the words and I thought, he's singing his pain. He's singing the pain of what he feels around him and what he sees. I didn't get the feeling that he was doing this because he felt that this is what people wanted to hear. This is what he wanted to say, and it resonates. Read the comments section. You're not going to read all 113,000. I mean, you're not going to get that done. Yesterday it was 99,000. Now it's 113,000. It's just incredible. 27 million views in 11 days. But you'll have Belgian, you'll have American. There are people who are identifying themselves. I'm a black worker, I'm Hispanic, I'm this. All the way down, all the different colors, all the different nationalities, the different genders. I'm a woman, I'm a working mother, I'm a working father, I have 2 kids, I have this, I'm in this state, I'm in that state, I'm in this industry, and it is just a brotherhood, solidarity, diversity, and in that comment section, again, to the point that the left would be jealous that they can't get it done by calling people names. Wow. If you haven't listened to this, absolutely listen to this, even if you're not working class per se, even if you're doing well, you can't help but be moved by the emotion in this song. So, yeah, I am not touching the car companies, no matter how interesting they get. Normally GM under 33, I'd be buying it because they have always recovered. They cycle in that nice big fat $10 range. It would not surprise me on Friday, the vote mandate almost 100%. It would not surprise me to see GM under 30 as you head in to the September 15th deadline. Wouldn't surprise me at all. Ford under 12 bucks, still not touching them. And that's it for the week. What's coming up this week? Jackson Hole, that's the big one. And NVIDIA. NVIDIA is going to be more important than the company itself is really in the grand scheme of the economy, because it is a story. It is part of that story, that AI story. It's part of that, and if it keeps that story growing and even leans into that story, I think you probably will revisit the rally you saw from the last NVIDIA earnings, and I think a lot of the negativity that's weighing on the market will disappear, and you could even go and print on new 52-week highs. But if it misses, it can take a lot of air out of that AI story, and maybe, going into September, you could look at another 200-300 points on the downside. It's pivotal in that sense. That's it for this week.